Hi, good morning, everybody. Welcome to this latest edition of our Expert Insights webinar series. Today, we're going to be talking about investment markets and our in-house prosperity fund that's managed by Nick. Nick's going to be doing a lot of the talking, but we're going to keep things conversational today. Just for those of you who don't know, we've done quite a few of these webinars on various topics, from everything retirement planning. We've spoken about why South Africans use offshore wrappers, estate planning, as well as some investment related topics such as the one today. So all of those webinar recordings are available on our website as well as YouTube. Good, so let's see what we're going to be talking about today. So we're going to be talking about, Nick's going to just talk about the current state of affairs in markets, and obviously this Iran conflict that's going on at the moment, the Raging Bull nomination that the fund has received, and Nick's going to give background around the Prosperity Worldwide Flexible Fund, a fund that most of our clients will be familiar with. And to talk about how it's performed, I think a really key area is the risk-return profile of the fund, which we'll talk about, who the fund is for, the management style, give some good examples about how the fund, how Nick manages the fund and takes advantage of irrational pricing within the market. Talk about positive changes that he sees in South Africa and opportunities in the market. And just close with some the current positioning on and some market views going forward. So just a little bit about Investonline before I start questioning Nick. We are a team of 15. We are financial planning and independent financial advisory. We work and we're all office-based and we work together in Newlands, Cape Town. But our clients are all over South Africa. We've got clients in Gauteng, up in Natal, obviously down, Western Cape, Eastern Cape along the Garden Route, as well as clients here in Cape Town as well. So we really do service clients all over the country. And where the name Investonline comes from is having primarily video meetings for our clients who do live around the country. And by having video meetings, this allows us to spend a lot of time with our clients and have irregular review meetings with our clients. So good. Nick, maybe let's just jump straight into it and dive into the deep end. Obviously, we have this conflict going on in Iran at the moment. The oil price is up over 50%, and there's quite a massive amount of uncertainty in markets at the moment. What do investors do?
Yeah, good morning, everybody. Stuart, thank you. Thanks for being with us. Yeah, listen, it is difficult times at the moment. And I think Mr. Trump, I think, must be under some enormous pressure. So it's always interesting with markets is trying to work out what markets are really pricing in. So it's quite interesting if we look at this chart. This chart is the MSCI World Index and the oil price. And one can see how the oil price has really spiked up over the last 2 weeks from when the war started versus the reaction of the MSCI World Index. So simplistically, global markets are saying that this war will pass and it will pass quite quickly. So the MSCI World Index is down 4.5% from the time that the US invaded Iran, and the JSE is down 9%. So the big issue really comes down to the oil price and the effect that it has on inflation. So the market is clearly saying that this war is going to end. The Strait of Hormuz is going to reopen. I think people had never really heard, or a lot of people hadn't heard about the Strait of Hormuz, but it's the biggest talking point in the world at the moment. 20% of the world's oil supply goes through that. And if the oil price does not come down and the strait does not open, inflation is going to go up. There's a general rule of thumb that generally for every $10 that the oil price goes up, global inflation goes up about 0.4%. So Mr. Trump cannot afford to have inflation shooting up, especially in the US. There's a midterm election coming up at the end of the year. And if inflation is up and rates can't come down, he's going to be in a lot of trouble. So I think he's at the moment probably fighting for his political career, and he desperately needs that Strait open. So we can have oil flow starting to come through, and that will then reduce the oil price. But the big problem is with the Strait and oil supplies is that there's a ticking clock that the Middle Eastern countries can only really hold around about another 20 days of oil stocks. After that, they don't have more storage facilities. They've got to start looking at cutting oil production. And with doing that, we start looking at a much longer, higher stranglehold on oil, and meaning a much longer, higher oil price. And that is just a shocker for inflation, and obviously interest rates staying where they are or possibly going up. And that's not good for markets. At the moment, there is a hope, and this is also what the market is pricing in, that central banks will look through further. And with that, it's also, I would say, with some hope that the oil price will come down and they will not react to inflation popping up now, meaning not just increase rates, but be more forward-looking with saying that this is just going to be a bump. Inflation might pop up, but it will come straight back down again. So that is all the positive side. But there definitely is quite a lot of risk that this could be more of a protracted war. And with that, we could have some higher inflation going forward.
Good, Nick. Well, let's get back to the Prosperity Fund. The fund was nominated for a Raging Bull Award this year. So congratulations for that. How's the fund done?
Yeah. Thanks, Stuart. We're very proud of that nomination, and it really was in the worldwide fund category. There are about 90 funds in it. So they nominate the top 3, and it's really also based on risk-adjusted returns. So certainly this fund does very well there because there's not a lot of volatility in the fund. We'll show you that, and that's what really got it up into the top 3. But certainly through inception, the fund's grown at 10.4% annualized. And if you look above the current benchmark, which is CPI plus 3, that's quite a bit ahead of that. And if you look at it on maybe more of a comparable basis to a balanced fund, and that's the multi-asset management sector, medium equity, that's grown to 7.8%. So the fund's done very well. It's outperformed those 2 areas, and it's very well suited for retired folks. So just to look at some of the risk return profile, the maximum drawdown has been, let's call it just 7%, and volatility of 4.7%. So if we look at the table below, you'll see that in terms of comparing it with the multi-asset medium equity, the JSC, and then just a global index, which is 60% equity and 40% bonds, you'll see that the fund's volatility or maximum drawdown has been significantly lower. And the reason for that is very much the way that it's managed. And we'll go through that in terms of the management style, and you'll see from the management style of why the volatility is significantly lower.
Good. Thanks, Nick. I know a lot of our clients will potentially have the fund, especially if they are retired living annuity clients or those saving for retirement. So, nice smooth ride is what you hope to achieve with the fund, and to manage risk while aiming for good real returns above CPI plus 3. So just tell me, for those who don't know, how does the fund fit in within Investonline?
Yeah, so it's interesting. It's almost by accident that the fund was started. So, I mean, Investonline was started some 16 years ago. And over the time, clients would say, every time we make a portfolio change, we send them a request, we speak with them, we give them the reasoning that we want to make a portfolio change. It came more and more often, clients would say, listen, Nick, you don't have to contact me every single time you want to make some change, because we do. We're proactive in managing portfolios. Can't you just do it without asking us? And I've always said, every time, no, we do have to ask you, we've got to get your permission. And some clients then said, well, why don't you just start your own fund? So clients asked, we started this fund, and that's the reason behind it. So how it really fits in, generally it's managed on a conservative, moderately conservative basis. I want to say it really represents our house view, and we include it in our conservative and moderate portfolios, which is largely for retirement clients, and we include about only 25% of it in their portfolios. The reason for that is I think it's healthy. Well, it is being very important to have that diversification, and to be disciplined about that. So only 25% would be in our client portfolios. So interesting about, who's the fund for? As I said, for retirement clients, it's probably best because of the lower volatility, and it also has a mandate to be able to invest offshore. So it's completely flexible. It invests locally, will go through the asset allocation and offshore significantly. So there's been times that the funds had a large position offshore, and times it's had a very small portion offshore and a large local. So that flexibility is really important. I generally manage the fund. I always think of it on an absolute return basis. We really look for real returns without excessive risk. And that's really shown and has come through in the fund's performance, and it's very low volatility.
Yeah, great, Nick. And I think something that you didn't mention was just how different the fund is in the market. There's a lot of unit trusts that if you're buying a stable fund or a balanced fund or even a full equity fund, where those funds have particular mandates that they have to follow in terms of how they invest and how much they have to have in equities. So often your balanced fund has up to 75% in equities, and your stable fund has up to 40% in equities. Where you manage the fund very differently, you can be 0% in equities, you can go a lot higher in equities, and the same with offshore currency, the same with bonds within those maximum limits you impose on yourself. But it's a very flexible fund, and that obviously helps you manage the volatility for clients.
Yeah.
So just on that, Nick, just tell us a little bit about your investment background.
Yeah, thanks, Jude. Listen, that was some good points. So there definitely is a uniqueness of the fund. And let me just quickly broach that. So the uniqueness is that we don't just select a long-term portfolio and reallocate it on very long-term positions. It's really actively managed, and that's really what's unique about it. The fund could have 0 equities or it could have 100% equities. And I think that's really a big difference. So, right, just back to my background. So my background is I've been in investments. I probably started investing 40 years ago. So that was when I got my first paycheck as a young article clerk. I was 21 years old. So I'm 61 now. And I think it's important I say that I'm 61 because I think age at the moment, I think, is important in terms of experience. I really do believe in markets that experience is a massive advantage. That experience really puts you in a good place because you've actually seen a lot of ups and downs in the market. And I think that really helps one be a little bit more rational in your investment decisions. So in any case, 21, I probably bought my first shares as a young article clerk. qualified as a CA, and got a job, went straight into the markets, investment markets. I was an analyst most of my time at a firm called Deutsche Securities. We were the top investment team, or let's call it equity research team, in the market for many years. And I was one of the top rated industrial analysts. I did the industrial holding sector, analyzed companies like Barlow World, Imperial, Bidvest, some of the construction companies as well. So I've done investments my whole life. Obviously invest personally myself in the market. So certainly do feel very qualified to be able to manage your money. And the big thing is really understanding the risk of different asset classes. And understanding the risks of those different asset classes obviously comes through in managing the fund.
Oh, good, Nick. And, congratulations on the performance of the fund over, it's almost, over 11 years now. So you manage the fund on a moderately conservative investment basis, and it's given good returns. Just tell us a little bit about how you actually manage the fund.
Yeah, so as I said, I manage it proactively. So proactively meaning taking advantage of irrational pricing in the market. So there's times in the market where just asset classes are out of sync, and I've got one or two examples. One example here is SA banks versus SA bonds. So I've got two different methods of valuation here. One is earning yields of the banks versus the bond yields, and you'll see that a big gap opened up going from mid last year towards the end of last year, where bonds really strengthened significantly, but the banks didn't. And that was just irrational from the market. It was like the foreigners came in, and the risk of SA being in a debt spiral had dissipated significantly, and they came in and bought our bonds. But with that, our banks weren't re-rated at all. And that created, to me, quite an obvious opportunity. If we just look at the next one, it's also just on a different valuation matrix, which is banks and their price to book. So from a price to book perspective, the big banks didn't go anywhere. And if we just look at the bond curve inverted, the bonds started to rally significantly. So that's just some irrational pricing. It's just an example of it, where one would take a position, and obviously within the fund, we bought a lot of the banks last year. And so if you really look at how the banks then subsequently performed, so if we look at the South African financial sector here, which is the blue line, you can see what that did from October last year. It's up like 27%, and the all bond index of the JSE is up 13%. So that gap that was there narrowed significantly, and it narrowed by the banks and the financials outperforming quite significantly. So I often talk about, in terms of managing it, two parts. There's, I call it being strategic and tactical. So strategic is taking positions that are generally probably about a year, not much longer than that. And that's where you would really like an asset class and effectively go in and out of it as the market gets volatile, and gives you better opportunities to buy it lower or sell it higher, versus tactical, when there definitely will be positions that are very short-term based. And the next one is really about the currency. So we just have a look at the Rand dollar. So that's a long-term valuation of the Rand dollar. And really what the chart is, it's purchasing power parity, which we call it the real effective exchange rate, which is the blue line. The red line is Rand dollar, and then the shaded blue is the debt to GDP of the country. So as the country's got weaker from a fiscus perspective, the debt's got higher, the gap between the currency and the purchasing power parity has widened because the risk has got higher and higher. So now that it looks a lot more positive that we're out of a debt spiral, hopefully that continues and that our debt to GDP eventually does come down, the gap should narrow between the premium, which is necessary to be there for the rand versus the US dollar versus the real effective exchange rate. So currently, where the market is, I certainly think, and very much from a political perspective, that the rand shouldn't be much stronger than 17. So it has rallied and came down to below 16. There was a lot of euphoria about, SA turning the corner, and I certainly think that is the case. But still, there's still a massive political risk that hangs over SA, and simplistically, it's really who's going to take over after Cyril Ramaphosa. And until there's more certainty about who takes over from him, fundamentally, I really can't see that the rand should be anything lower than 17 to the dollar right now. So here, in terms of managing the currency exposure, with those views that I've just outlined now, the rand came down, and it came down to 16, just to below 16, and I certainly believe that it was overdone from a strength perspective. Even though I am fundamentally positive on SA, longer term, it had just strengthened too much too quickly. So that was an opportunity, and the fund bought dollars, and we bought dollar cash. And I'll show you in the asset allocation just now that we've sold half of that. So even though it's just a small little uptick, that's how we generally just make profits in the fund with this kind of irrational pricing.
Good. Thanks, Nick, for that background on the methodology of how you manage the fund and take advantage of mispricings in the market. How's the fund currently positioned?
So quite interesting. I've got two asset allocations here. One is just before the Iran war started, and then the current position. So before the Iran war started, the fund was very conservatively positioned, and the main reason was that we felt that equities had run fairly hard. SA equities had run hard. I showed you the rand dollar exchange rate, which I thought had been overdone, so we bought a lot more dollars. The week leading into the war, I sold more than half our equities, and a lot of those were SA equities. And then the war, there was probably definitely some luck that the war started just after that. But it was a position of that, you had this whole US Navy fleet sitting on the shores of Iran. There was quite a good probability that there was going to be some war. If you cast your mind back to the Ukraine war, when the Russians were sitting on the border of Ukraine, the market, I believe, the most of the market never thought that Russia would invade the Ukraine. So just on a probability basis, markets had run. The risk of an invasion would cut our equities significantly. And we had US dollars that we had bought. Obviously, that has panned out well. So if we now look at the current position, and this is only 2 weeks later, is sold half the US dollars with the rand spiking up, and the market has come down, and the JSE is down about 9.5%, but the banks are down even more than that, and also some of the SA Inc. stocks are down more than that. I've started to buy more local equities. So we've increased our local equities in the last 2 weeks from 12% to 13%. And that's our current position. It's still very conservatively positioned. I think that there isn't a significant amount of downside to local equities because I think that they're so cheap. So even if we do have a big market correction, or effectively this is a protracted war, I certainly believe the SA local equities will come down far less than global equities, given their cheap valuation. Good.
Sorry, Nick, I think you just misspoke and you said 12 to 13%, whereas we can see it's 12 to 33% that you've done an increased local equity position. So that's a good active move there. And then, Nick, I mean, what do you think of markets then looking forward from here?
Yeah, so where we are now is, as I said, positive on SA equities relative to global equities. And just wanted to just put up this table, which is a very good table. I didn't put it together, but it really just outlines how SA's improved. And if you just look at, from an energy perspective, I mean, days of load shedding have, decreased significantly. I mean, transport has improved significantly from where rail volumes dropped by 34%, now they're up by 15%, being moved off the grey list. The economic growth outlook is looking a little bit better, but still anemic. Obviously, that's got to improve significantly. The bonds have strengthened significantly. I mean, that's a big vote of confidence from the foreigners, saying that, our debt is not close to as risky as it was 2 years ago. Obviously, inflation is far lower. I mean, that's really a good environment, better environment for the consumer, and we can lower rates further. And this has all been represented by a much stronger currency. And clearly, that's also been helped by our precious metals rallying significantly. So that's helped a lot as well. Obviously, that adds to better tax returns, tax collections, and it obviously strengthens the government fiscus. And obviously, the credit rating agencies have improved our outlook. So SA looks like it's turned the corner, looking better. There's huge potential. It's just politically, that's where the risk really sticks out. And the bottom line is for the SA market to really, let's call it the SA Inc. market, to really re-rate, we need the foreigners to come back into the market. And the foreigners are only really coming in when they can see some real good signs of economic growth. When they can see signs of economic growth coming in, then they'll feel more confident to come in and buy our equities. So in terms of our market views, so we know that global markets have been near all-time highs. And so that's not been good for this Iran conflict, because it's often, you can use the term price for perfection. So it certainly doesn't need a view that inflation might be higher, interest rate cuts might be less. Currently the US market is forecasting a rate cut of only maybe 25 basis points this year. Before the war, it was like three cuts of 25 basis points. And even at the moment, there seems to be quite a wide disparity in views. There's still some people in the market that think that there is going to be 75 basis points cut versus 25%. So there's that uncertainty. So always with these issues, the one place that you're going to go back to is valuation. And that drives the market longer term. And if you look at the world MSCI index, the forward PE, it's still relatively high. And at a forward P of 18, there's definitely still some downside risk to it. So we are cautious about global equities, really hoping that this war comes to an end soon. And when we say soon, certainly within the next month. Else, I think there is going to be a lot more downside pressure on global markets. So the one issue I just want to highlight with markets being so high, as in terms of the profitability that is in global companies, and we're just going to look at the S&P. So the S&P makes up 70% of the world index. So this chart just shows the operating profit margins of US companies. So the green line is operating profit margins excluding the big mega cap 8 companies. It was like the Magnificent 7, now the Magnificent 8. And that's what the red line is. So you can see the profitability of those companies are sky high, near 27, 28% operating margins. The big one, NVIDIA, I think it's near 50%. So the big question really is, how sustainable are those operating margins? There's always this thing about profitability will revert back to the mean again. So a big risk in markets, or especially US markets, is that companies are very profitable. Their operating margins have gone up significantly. And even if you just look at the green line, which excludes the Mega 8, their operating margins are up at about 12.5%. And if you really rewind further, those margins previously, going back into the 90s, were only 7%. So operating margins, companies are a lot more profitable. A big, I think, reason for it probably is the internet and computers and emails. That's added to the efficiencies of companies. Clearly, people will start saying, well, what about AI now? AI definitely will also add to the efficiency as well. But American companies are at all-time highs from a profitability perspective, and then also from a valuation perspective, which just does make you caution that we are on very high levels overall. And then lastly, just SA, where I've said SA is cheap, and you look at the SA PE. So this is also the forward PE of the SA market. And even though we've had a sharp rally, a lot of that was really just about the gold shares. Gold shares are up 4 times over the last year. Platinum shares are up twice since then. There's a lot of deep value in SA, and that's just across the SA Inc. part. So SA Inc. is just generally retailers, industrial companies, excluding NASPAS, and the banks. So any positivity that comes into SA should see some significant re-rating potential in the market. And I still believe that there's still some very good returns to get out of SA going forward.
Good. That's very interesting, Nick. Thank you. What closing thoughts do you have?
Yeah, so I think probably the biggest thing that we see, Stuart, is the whole issue about risk. And risk is good. You have to take on risk to beat inflation. So you can't just have all your retirement money just in a fixed deposit, because after tax, you're not going to beat inflation, and you're actually just going to get poorer. So you've got to have some kind of measured risk. So I think there's got to be an expectation about what kind of return one really can get. So just to describe, so equities over time have given you an 8% real return. So that's real. And if you add in inflation on top of that, let's call an SA average inflation currently, let's say, is 4 or 5%. So that would be a 12% nominal return. Markets have done very well over the last 3 years. So the real return in the SA market has been 16%, so which has been double the average. And I just feel that people mustn't get complacent that this kind of return is going to continue. I think that returns will be in the market will still continue, but not at the same high levels that we've had. So my point is to manage your expectations in terms of what kind of returns you can get, and effectively look at how much risk you really can tolerate. And obviously, from being a younger person, you can take the dips, the ups and downs in the market, and you can take on a much more risk because you can tolerate some kind of big drawdown that takes place. Remember, markets do go through corrections despite crashes that we do have, and you've got to be able to go through those declines. So you've got to have a balanced portfolio as you get older into retirement that allows you to be able to stomach the ups and downs, but you've got to still have some risk, i.e. at least probably 30 to 40% of equities in your portfolio to be able to beat inflation.
Good. Well, thank you, Nick. Thanks very much for your insights. I'm just going to do a little bit of closing and just remind everyone about our service offering. Anything you want to touch on before we close up for the day?
No, I think, that's it. I think probably the best is to have a look at how you're positioned. And, if you want us to help, we'll have a look, we'll do a portfolio analysis for you. And obviously we do the financial plan, which will assist you in seeing, do you have enough money for the lifestyle that you actually want to live?
Good, excellent. Thank you, Nick. I must say it's very interesting. Even I learned quite a bit about where we are in markets at the moment. So just to remind everyone, I know that we did have questions submitted for the session. We didn't have a formal Q&A style today, so we did try and incorporate quite a few of the questions and the themes we saw in the conversation. If there were any particular questions around markets or your portfolio or the Prosperity Fund in particular, our team of financial planners are going to get back to everyone, and we are available to have, what we call these introductory meetings if you're not a client of ours yet, or if you are a client of ours, obviously you can chat to us at any time. So just to remind everyone about our, why clients choose Investonline is that we do have the proven investment experience. A lot of that history of investment experience comes through Nick's experience that he shared with us today. But I think everyone in the team is very good in the investment space and on top of markets. We've got completely transparent fees. So we have what we feel is fair and low ongoing financial advice fees that we charge. We don't charge any initial fees or commissions for anything we do for new clients. And we do offer family pricing, which means we will price a family, which can be various generations or siblings, or whomever it may be within a family unit. We offer everyone a family fee across the platform fees and advice fees as well. We all work as a collaborative team. As I mentioned earlier, we all work together in our office in Newlands, and we really feel that collaboration adds a lot of joint insights into what we do for clients. And for our clients that are invested with us, we have a very strict internal protocols around ongoing reviews and regular meetings so that you always stay in touch with us, and we're always on top of your portfolio as well as your tax planning or retirement planning and whatever may be relevant to you or pressing for you in that moment. So good. We will be in touch about our next webinar, which will likely be in May. We'll get a topic together soon that you'll be able to register for. As I mentioned, we will be in touch with everyone to answer any questions that were submitted. And if you are looking for either a review of your portfolio or of your overall retirement plan, or if you just want to chat about markets, our team is available, and you can just get in touch, and we're happy to have a conversation with you. So thank you very much, and enjoy the rest of your day.